Good morning. We'll go ahead and get started. This is Mahesh Odhrani with Strategic Wealth Design. It is my pleasure to welcome you to our fourth and final financial wellness webinar series. And thank you for being on the meeting today. And thank you to individuals who have attended some or most of the other ones as well. A couple of housekeeping items. This meeting is being recorded. Everyone is on mute currently. And this meeting is being recorded, and the recording, once it goes through the compliance approval process, will be made available as well. There's a questions and a chat box as well. So if you do have any specific questions as I go through the presentation, go ahead and pop them into the questions box. There should be a questions feature inside of the GoToWebinar app that should be on your computer. So feel free to pop in any questions if you have any questions around the topics being discussed today or anything else financial related. There's also a chat box as well. You can feel free to throw some questions in there too, and I'll monitor both of those as we go along. And I'll take breaks into at certain time frames to ensure that we address those questions either at that time or the tail end of the meeting. The tail end of the meeting, we're going to have a Q&A as well. There is a handout, which is the workbook that was emailed out yesterday as well. If you did not receive the email or you perhaps missed it, in the handouts section, you'll see a workbook as well for today's topic, which is retirement income planning. So go ahead and download that because I think it's a good workbook for you to complete and fill in as we go along. And that's pretty much it. So let's go ahead and get started. Well, thank you again, everyone, for being here. Today's topic is all about retirement income planning. If you attended last week's topic when we were talking about saving for retirement and the different vehicles available, one of the comments I always make around savings and planning for retirement, the amount of money that you save for retirement, it's all based upon an individual's perception, what their lifestyle is going to look like, but it's meaningless with the amount of money that we save. In a sense, it needs to add meaning. Our money needs to do something for us. And at retirement, the amount of assets and the amount of investments or whatever you save and you get to retirement, it needs to add meaning. It needs to do something for you. And the purpose of saving for retirement is to generate retirement income, because throughout our most of our career, throughout our life until we get to retirement, we're used to living off of cash flow. We're used to living off of income, and that's how we pay our bills. And unfortunately, when we retire, the bills don't stop. Some of them may go away, but they may not completely stop. So it becomes important to, when you're planning for retirement, is to plan from the perspective of income, and that's what we will talk about today. So the goal with saving for retirement is to have multiple sources of income. So we'll talk about sources of income available. We'll talk a little bit about investments and how they work in retirement, because the story behind investments is a little bit different at retirement. And we'll also talk about the different things that you have to think about that you may not, or I call it speed bumps, that we may not have recognized that would exist in retirement as well. So we'll talk about those too. So this is the agenda, and planning for retirement is like planning for a vacation. So when we go on a vacation, we want to plan for the destination, how we're going to get there, what we're going to do, what is it going to look like, and it's very similar to that in the sense that for planning for retirement, we have to identify goals, where you're at currently with your current sources of income, looking at what's the vehicles, what are the financial products and services that may get you there, and also being aware of some of the speed bumps that exist in retirement, some risk, healthcare costs, ongoing expenses, and then charting out that map or that pathway to get there. So that's essentially what we're going to talk about. So what does your retirement look like? So that's the first step, is identifying what do you want that retirement to look like, and it's a destination that you want to get to. And have you been thinking about it? Have you been dreaming about the future? What you would do after you leave sort of that work environment and leave that career? Do you plan on spending more time outdoors? Do you plan on picking up an RV and traveling around the U.S.? Do you plan on being by the beach? Are you planning on downsizing? So what about other purchases that may come up? Replacement of cars. So it becomes important to identify what do you want that retirement to look like. And with most retirees that we work with, the challenge that we face is when they retire, the first 6 months are spent doing sort of a lot of the to-do list and what I call the honey-do list, or perhaps projects that have been pending for a while. But if you're not going to work and you have all that time available, most of those projects are usually done in about 6 months or so. And it's after 6 months that it hits individuals, okay, what do I do next? So it becomes important to identify what does retirement look like for you? How will you spend that additional time that you will have in retirement? Will it be with family? Will it be with doing charitable work? So identifying those and building out those hobbies and interests, perhaps in advance of getting to retirement. So when you get to retirement, you're not having to think through those at that time. All right, so let's talk about for a moment the reality of retirement for a lot of individuals that's in the U.S. today. So most, and it's exemplified by this chart. So this talks about the projected growth rate. Bear with me here. I'm going to move the screen from here. The projected growth rate in labor force at different ages between 2014 and 2024. And as you can see, the annual growth rate in the labor force is the highest when individuals are in their 60s and 70s. And why that is so is because many individuals, they retire and they realize they have not built that sense of purpose in retirement, and they're getting back into the workforce. So it could be for multiple reasons. It could be where they don't have a sense of purpose. It could be they're running low on money and they thought they could retire with the amount of assets and income that they had, and they're getting back into the workforce for bridging that gap in retirement. So, however, even studies have shown that 54% of workers in their 50s and 60s still plan to work part-time after they retire. And this was a study done by Transamerica, and the study date was, I believe, in 2018, so it's a fairly recent study as well, that 54% of baby boomers in the 50s and 60s are still planning on working part-time after they retire. And that number is even higher for Gen X and millennials. So Gen X is the same as 54%, but the millennials are 58%. So more and more individuals are thinking about still working in some capacity in retirement. However, you look at another study, and this is back from 2013. The study was conducted by MetLife, and they found the average age of retirement is 63. Now, people retire for a variety of reasons. Some retire because of health and the times that we're in with COVID and unemployment rates being where it's at. Some people are forced into retirement early as well. So even though a large chunk of individuals are saying that, hey, we plan on working part-time in retirement, the average age is still age 63. It's because either people are retiring for health reasons, or perhaps they became unemployed and then they just said, listen, I'm just going to retire, might as well just retire early, or it could be some other reasons as well. So, but not everyone is even though they're planning on working in retirement, but may not, based on this MetLife study, they may not be working in retirement as well. So that's to keep interesting statistics to look at. So when it comes to planning for retirement, and you may or may not be able to retire due to a variety of reasons. You may retire early because of health. It's good to have a plan. It's good to have that roadmap. And where you start with that roadmap is essentially starting with what's important to you and what are your goals. How do you plan on spending that time in retirement? With traveling, or you're going to be spending it with family? Would you purchase that new home and downsize from the home that you're currently in? Would you want to purchase a vacation home somewhere else so you have a getaway to get to? And hopefully today we can start helping you craft some of those answers as well. So I want to take a pause for about a minute and go ahead and open up the workbook that you have in front of you and write down what is important to you in retirement. what do you envision that retirement to look like? And just jot down a few notes for yourself. So I'm going to pause for a quick minute. All right. So now that you've written down what's important to you, let's talk about retirement and the time horizon of retirement. So when an average retiree, an average 65-year-old retiring today, is expected, a healthy 65-year-old is expected to live in retirement for at least next 20 or 30 years, and that's almost as much of the amount of time that we spend in our careers as well. So because of all the medical advances that we've had, longevity has increased significantly in the last 15, 20, 30 years. That in retirement now, a significant amount of time is spent in retirement. And one of the biggest concerns that individuals have in retirement is running out of money. So it's important to understand what would impact your retirement spending. And longevity is what we were just talking about, is that risk that people are living longer. And we'll talk about some of these things, other things as well as we go along. So the first thing is people are living longer. So if you and your spouse are around age 65, as of today, there's a 50% chance that one of you will live to age 92, and 25% chance that one of you will live to age 97. The average life expectancy for a male today, 65-year-old male today, is expected to live till age 87. An average female is expected to live till age 89. So as you're looking at this, when you're looking at planning, and if you're planning on retiring at age 65, if you just look at some of these numbers, and if you have good longevity in your family, so you have good family history, you're fairly healthy at 65, well, you're going to plan for the next 25, even 30 years in retirement. So any projections that you look at from retirement perspective and how long your income will last, the projections, you should really plan for the next 25 to 30 years. In most of the planning that we do, we at least go to age 95. And if there's really good longevity in their family and they have family members living into 90s, then we may even go to age 100 or 105 for individuals that are, let's say, in their 40s or 50s, because the likelihood with medical advances, by the time they get to age 65, this age, this average, these numbers, these statistics will also increase, that they'll have longer longevity as well as they age. So it becomes critical, and as you're planning on looking at a time frame as well. And the unfortunate truth about living longer is inflation. Now, we know inflation exists. The last 10 years, the average inflation rate has been about 1.8%. The inflation in the last 12 months as of November 2019 was 2.1%. That's a pretty cool calculator, the US Inflation Calculator.com. If you go to that calculator, you put in a product that you purchased that's been around for a long time, let's say for 30 years, like a can of Coca-Cola. You can put that in there and it'll tell you what a can of Coca-Cola cost about 30 years ago. So it's a pretty nifty calculator that you can use. But inflation, the longer you live, the bigger the impact of that inflation is going to be. Because over time, it really creates a drag on your assets and your retirement. So inflation is one of those silent, what I call the silent silent killers that impact your retirement significantly, especially the longer time horizon you have. So, and if you retire, let's say if you're lucky enough and you save well, you retire at age 55 or even 60, well, the impact of inflation is going to be even more than a retiree retiring at age 65 because of the time horizon. The next thing to look at is healthcare expenses. Now, many retirees are concerned about this, and rightfully so, because the average 65-year-old couple today, they spend about $285,000 on healthcare during a 20-year retirement. Now, Medicare covers some healthcare cost, and this $285,000 is out of their own pocket, not counting the Medicare cost. So Medicare usually only covers about half of the total healthcare cost and does not pay for any long-term care expenses. So we'll talk about long-term care in a moment as well, but that's another major risk if you were to experience any type of long-term care situation. Long-term care is if you can't take care of yourself. So you need to either be in a facility like an adult daycare or nursing home facility, or even have someone come at home and take care of you. But that is also another major risk for retirees today, because we're living longer. It doesn't mean we may be living healthier. We're living longer, and sometimes we may be sick and living in long-term care facilities, but we have a longer life expectancy. So we may be spending more time in long-term care facilities than historically we did in the past. So average out-of-pocket healthcare cost for a person with Medicare is still about $5,500 per year. So these are things to keep in mind, that when you get to retirement, healthcare, and generally healthcare expenses are higher when you're in retirement than when we are in our 30s or 40s. So 7 out of 10 individuals over age 65 will need long-term care at some point in their life. We're just talking about long-term care. This is what the average cost looks like for long-term care services. Home health care, about a little over $4,000 per month. Adult daycare, we can see it's about $1,600 per month. Assisted living, $4,000. Nursing home, semi-private, about $7,000 per month, and a private room would be about $8,500 per month. Now, these are some of the average costs. These costs fluctuate depending upon the area and the region that you're in as well. So somewhere, perhaps in New York, these costs are going to be significantly higher versus in other states or cities where the cost may be significantly lower as well. This is what the average is around the country. So these large expenses in retirement can impact your outcome for retirement as well, and put you at risk of potentially running out of money. Now, how do you protect yourself from long-term care risk? Is by purchasing a long-term care insurance policy that helps offset some of those risks associated with long-term care. Now, we're going to pivot a little bit. We talked about some of the health stuff, right? Now we're going to talk about investments and returns and the sequence of returns. So when you're saving and when you're investing in your 30s, 40s, and 50s, when those returns happen does not have a significant impact in your retirement, for your retirement, because you're saving and you're accumulating. So there's two phases when it comes to investing. There's accumulation phase and what we call the distribution phase. And if we make a mistake on the accumulation phase, you can generally fix those and catch up to a certain extent. However, when it comes to retirement and being in that distribution phase, if we make a mistake or if the markets don't perform as we had expected, there's no fixing those mistakes. So they have to be crafted appropriately, or there's not too many choices to fix those mistakes. So distribution phase, you essentially only get, I would say, one shot at making sure we get it right. So the sequence of returns is a risk that impacts retirees more so they would retire someone saving. And it's how those returns happen. And here's an example of what I mean by that. So the timing, you've probably heard this phrase that timing the market, like no one can really time the market, and it's not about timing the market, it's all about time in the market. So, but when it comes to retirement, timing does matter. Unfortunately, we still don't have a crystal ball to see what the impact is going to be, but this is an example just to show you what that looks like. So this is showing a portfolio with $7,000 of yearly withdrawal leaves a portfolio of $100,000. It's a $100,000 portfolio. We're pulling out about 7%. And portfolio A, we can see in year one, after the correction of the 18% correction, we see that portfolio A is after the $7,000 withdrawal plus the correction is down to $75,000. However, portfolio B, on the other hand, had a better return in the first year, so the portfolio is up. Now, if you look at these returns of portfolio A and portfolio B, they're exactly the same. They're just inverted. So portfolio A is experiencing a negative returns for the first 3 years versus positive returns at the tail end. Portfolio B has those exact same returns, but they're inverted. They're experiencing positive returns in the first several years and then negative returns later on. What you see here is starting the $100,000 balance and how much the individual is pulling out, the couple is pulling out per year, is that in portfolio A, they run out of money in the 13th year. Versus portfolio B, on the other hand, has grown well, and even with the corrections later on in the year, they're still way ahead. So what this tells us, what this example shows us, is that when you retire, negative returns early on in your retirement can have a significant impact and increase or exemplify that risk of the sequence of returns risk in your portfolio that you may run out of money at some point. So it becomes critical, especially in the first few years, I would say 3 to 5 years, to manage expectations if there were negative returns, and perhaps looking at ways to minimize that risk, as well as looking at ways to minimize what I call is the burn rate. So the burn rate of $7,000 per year is minimizing that burn rate in the first few years so that your portfolio has time to recover. So the sequence of returns risk impacts every individual that's retiring because, again, we cannot predict, we don't have the crystal ball to predict if we're going to get a negative return or not, but it becomes important to manage those expectations as you go into retirement. So what spending strategy makes sense for you? Once you get to retirement, essentially there are 3 strategies that we deploy, that we come across, depending upon the clients and what's their right fit, what's their goal, what their goals are. We're able to craft essentially one of these spending strategies when they get to retirement. And we'll go through the details on these as well. But one is systematic withdrawals, the other one's an income floor, and the last one what we call is a bucket approach. So the bucket approach, I'll just cover this real quickly here because it's not on another slide. The bucket approach, essentially what that means is you're bucketing and using time to bucket your income strategy. The bucket approach would be, for example, a short-term, mid-term, and a long-term bucket. So you divide your investments into 3 different buckets, and you categorize them. Okay, this is going to be my short-term, 1 to 5 years. This is going to be my mid-term, 5 to 10 years. And lastly, I'm going to focus on my long-term bucket, which is 10 to 20 years. Each investment bucket generally has a different investment strategy, where the short-term bucket is going to be the most conservative. You'll take a little bit more risk on the mid-term bucket, and your long-term bucket, you're going to take the most amount of risk because it has time to recover from any market swings that may happen along the way. So that's what a bucket approach entails. Now let's talk about systematic, and we'll talk a little bit more about the bucket. Systematic withdrawals. Now, systematic withdrawal allows you to receive regular payments from your investment account. So either we define it based upon percentages or a fixed amount. If it's percentage, then it could go up or down. If it's a fixed amount, that could come out from an account on a regular basis. Now, it could be determined based upon your fixed expenses that you need to sustain your lifestyle at retirement. And the benefits of the systematic withdrawal include, 1, the ability to generate income with flexibility and control, because you can control increasing and decreasing some of that depending upon how the investments may change. Looking at the protect against inflation as well, so we can adjust those benefits upon inflation. As inflation goes up, we can adjust those benefits up as well. And sometimes it provides tax benefits as well. So rather than pulling out a lump sum and spending it, we can create some tax strategies and minimize tax consequences, because the reality is, and as if you remember from our last meeting from last week, we talked about the different retirement vehicles, and different retirement vehicles have different tax structures. So like a Roth account may not be taxable versus a IRA or a pre-tax 401k account will be taxable at retirement, and then sometimes what I call is non-qualified investments, so investments in like a brokerage account, have different tax treatments with capital gains and dividends and interest. So by doing it on a monthly basis, it gives us the ability to manage some of those tax programs a little bit better than doing it as a lump sum withdrawal. Some of the challenges with systematic withdrawal, some of the risks that exist, payments are not guaranteed, so which means that if you're pulling out too much, you could run out of money at some point. Since your entire account is essentially all or multiple accounts are invested, are fully invested, and it's subject to market fluctuations as well. So your account is because it is liquid and flexible and how it's structured, sometimes the challenge becomes that it's more accessible. So if another bill comes up, or you just come up with a vacation an extra vacation that you want to take, it becomes easy to access the money because they haven't been structured in the other two ways that we'll talk about. Sometimes people don't realize that they may overdraw their accounts, not in terms of banking, but they pull out too much in any given year. They may not feel the impact that year, but it would take it from the back end where they may be at risk of running out of money at some point. So it becomes important to identify some of those risks when it comes to systematic withdrawal, and be a little bit more diligent about how we pull that money out when it comes to the systematic withdrawals. The income floor plan is basically what we set up is a floor to cover all the basic essentials. So essentially you categorize all your expenses into essentials and non-essentials. So like that vacation would be a non-essential, but putting food on the table, paying for utilities, paying for gas in the car, or if you still have a mortgage, we're paying for a mortgage, those become essentials. And essentially you split up the two buckets into your basic expenses, your needs that have to be met every single month, and then your wants, which are those discretionary expenses, the vacations and other things that you may want in retirement. And then what we do is we look at, for the basic expenses, the day-to-day, month-to-month expenses, we want to look at guaranteed sources of income or very low-risk investment sources. So low risk would be interest from bonds as an example. Guaranteed sources are going to be like Social Security or guaranteed annuity income. So it becomes, in this strategy, it becomes important to have at least your essential expenses match up with your guaranteed sources of income, or at least low-risk investments. And then what we do, the secondary bucket, which is discretionary spending, everything else goes in the discretionary bucket, and that bucket is essentially only used for, you only spend money from that based upon returns that are generated from that investment. So it's managed over for a longer period of term to keep up with inflation. And if some years the returns are well and you made some money on that account, then you may have the option to take that extra vacation, or you may have the option to take a better vacation that year and to spend a little bit more. But in other years, when the returns are not there or they're down, you may have to sacrifice on that discretionary spending and sacrifice on that vacation for that year and wait for the markets to come back. So that's how you design sort of an income floor strategy, basically covering your essentials and your basic needs with guaranteed or low risk investments, and then anything that's discretionary can be invested a little bit more aggressively so that you're using the returns off of that portfolio to pay for those discretionary expenses. Next is the bucket approach. We talked about those different time periods that we can set up for the bucket approach, the short term, midterm, and long term. And now, again, it's not a one size fit all that it's 1 to 5 years. Every situation could be a little bit different depending upon other financial commitments that they may have while in retirement as well. But it involves splitting up the investment strategy into different buckets. Generally, you would see about 3 buckets, but we have also seen as many as 4 or even 5 buckets, depending upon what the goals are for that individual or that family or that couple. So the benefits of doing it this way, the bucket approach, is so you have specific time periods. It's easy to solve to say, okay, you know what, we know this bucket's going to run out in about 5 years, or it's going to run out in about 10 years, and we can craft investment strategies based upon that. If you have losses in the investments in, let's say you're in your first 5-year bucket, a short-term bucket, in your first 5 years in retirement, well, if there's losses in the midterm or the long-term bucket, we're okay because we're not going to touch that money for another 2, 3, 4, 5, even 10 years. So we know we have more time for those accounts to recover over time, so we can sustain the volatility in those buckets over time as well. The difficulty in some of the challenges with the bucket approach, it does take a little bit more monitoring and crafting. The design, it becomes extremely important, but it is a little bit difficult. If your goals change along the way, then we have to move the different buckets and move the different time frames as well. So it becomes a little bit more difficult to manage, but for some individuals it works great because mentally they have these different buckets and different accounts set up, knowing which ones they're going to touch at which time frame. So talking about the different strategies, regardless of which strategies that we choose, we have to also look at how long will your money last. And what we look at is the withdrawal rate. How much can you withdraw from your account, and how long would that account essentially will last? Now, the number that's thrown around a lot in our space, in our business, is around 3 to 4%. Is that safe number, that whatever portfolio or how much you save in retirement, you can essentially pull out about 3 to 4% without having a significant risk of running out of money. But if you start pulling out more than that, then there would be a significant risk of running out of money at some point, or running out of your assets. So this just shows us that if you're pulling out 10% of your portfolio, and this is looking at a 60% stocks, 30% bonds, and a 10% cash portfolio. And if you start pulling out 10% a year, all that money is only going to last about 10 years. And if you pull out 7% per year, that's going to last about 13 years. But if you were to drop it down to 5%, it would give you about 20 years worth of income before you run out of money. Now, again, it depends. If you're retiring at 65 and you have good longevity in your family, and as we looked at the statistics, the average age, an average male lives till age 87 and female lives till age 88. So based upon those numbers and those statistics, the 5% also may not accomplish that goal. So you really may want to look at the 4 or even a 3% withdrawal rate from the portfolio. So it becomes extremely important if you take a look at your entire retirement asset and retirement nest egg as to how much you can pull out. That's the number I would probably go with. Now, what we always look at for individuals that are not in retirement today, you can run projections to say, okay, you know what, if I'm saving this X amount, this is how much I will have when I turn age 65. Let's say that number is 500,000. And with Social Security, this is what my income would look like. You can just pull up a Social Security statement, look at your sources of income, and be able to see what that payout from Social Security would look like. And you can run some projections to see, on average, how much you will save, and if you were to pull out 4% of that, what would that income look like? So, and we'll talk a little bit more about, as we go through future slides, on calculating your income sources as well as developing that game plan, that roadmap. So it becomes important to take a look at this. Oh, there we go. Next slide, we're just talking about creating your map. So these are 4 things we're going to talk about. So the first step to looking at your map, generating your goals, is looking at your income sources. is to run through and see what income sources would you have in retirement. So one, pensions. If you have a pension plan, not a lot of private businesses are offering pensions anymore. Most pensions nowadays are offered through state and federal government. But will you have a pension? Social Security, what would that look like? Now that's very easy. You can go to socialsecurity.gov or ssa.gov and be able to pull up your Social Security statement. I would highly recommend going on the website, registering your account. So you can create your own account and being able to monitor your Social Security benefits. What would they look like at retirement? And the system does make some assumptions as to continuation of your same income level. I think it also adjusts for inflation and shows what would that potential benefit look like for you at retirement. And that's something you can calculate today, regardless of what age you are. Would you want to continue working part-time? Would you have to work part-time? So if some of these sources are not going to be enough, you may have to work part-time. And what would that income look like when you do end up working part-time? Do you have any type of real estate properties, rental properties that may generate some rental income? Then you have to go into assets. So retirement accounts, savings accounts, looking at how much those accounts will accumulate over time. If you're working with an advisor can usually run those calculations pretty easily. If you are participating in a 401k plan at your employer's at your work, then your employer, that 401k company, if you go onto their website, most companies have projection tools as well that you can run some calculations based upon how much you're putting in, how much match, if you're receiving a match by the employer, what would the outcome look like at retirement? So calculate those retirement assets, retirement accounts, what would that look like? Any savings accounts, any other investments that you may have. So identifying your income sources is important, and those assets. And remember, I would recommend using that 3 or 4%. So whatever those retirement assets, accounts, and savings are, use 3 or 4% off of those accounts as your income source. So for example, if you're anticipating $500,000 to be saved up by the time you get to retirement, use 4% or 3% of that number as your income source. And the next is looking at financial events. Inheritance. Would you have an inheritance that you may receive from parents or grandparents? What about real estate? Will you downsize? I mean, that's why we see a lot of retirees moving from California to Nevada. The difference in the price of a home between California and Nevada, it's almost 50% or even 60%. So they could essentially sell that home in California, assuming they buy a same size home in Nevada, they would still be able to pocket anywhere from, I would say, between 30 to 50% of the sale of that house, and they could use that for their retirement income purposes. So these financial events, are you planning on downsizing a property? Could you take that equity that you from the selling of a property and invest it and generate income from that as well? So identifying those income sources become important. And then estimating your retirement expenses. That's the next step. What will your retirement look like? Are you going to have a mortgage at that time? What will the mortgage be paid off? What will your housing expenses look like? Will you be renting in retirement? Utilities, what would that look like? Other personal expenses, healthcare and insurance, that becomes important, factoring in Medicare premiums and healthcare costs in retirement. Would you have any family obligations to provide for family? Sometimes we have seen individuals are retirees are taking care of grandkids, or retirees may like if someone's retiring and the parents are still alive and they have family responsibilities with their parents as well. So this family care responsibilities also have to be factored in. Will you have some of that? Have your parents taken care of their own retirement? Will they be okay, or will they depend on you while you're planning for your retirement? Will they depend on you to help them out in retirement? So that becomes important. Transportation, recreation, entertainment, charitable giving. Now, charitable giving is we see a lot of individuals can give to charity in multiple ways, with what I call is with their labor and with their hearts, and provide actual service, manpower, or they could give it with their wallets. So how do you want to give to charity as well? Because that has to be estimated. If it's truly going to be with your wallet, then that has to be factored into your retirement expenses as well. Step 3 is to start looking at your investments and diversifying your investments. So other things to look at: what does your time horizon look like? We talked about longevity, right? How long will it take you to get to retirement? What's that retirement age going to be? And what is your longevity going to look like? Are you going to be retiring at age 70 and your family history is not that great? And should we plan for the next 15 to 20 years? Or are you going to retire at age 60 or 65 and you have great family history and now we need to plan for 25, 30, maybe even 40 years? So the time horizon has to be defined when you start planning for retirement. Keeping pace with inflation, current liquidity needs. Are you going to have additional expenses, or what would give you that safety net in terms of have the money in a bank account, savings account, checking account, so that you can rely on that if the markets, if the investment didn't perform well for a few months or maybe a year, at least have some liquidity, some cash or some assets available from a liquid perspective that you can touch easily without tax consequences and without penalties. Diversification of asset classes. Again, you've heard me say this before when we talked about investments. Diversify. Don't put all the eggs in one basket. And the different asset classes, the different types of investments. Take a look at longevity protection. We talked about which is annuities as well as long-term care protection. So take a look at some insurance and some annuity type products to protect you from living too long and running out of money. And looking at the product allocation, how much you're going to put in stocks, bonds, insurance, or even real estate. So diversify your investments. Determine your withdrawal strategy. So I went through these withdrawal strategies at a high level. Some of these strategies can, depending upon individuals or a couple's goals, can have perhaps a little bit more output in terms of retirement income. It just depends upon the strategy and the individuals and their goals, which one may make more sense in their lives. And definitely work with a qualified financial professional who understands these different strategies so they can assist you in crafting what would make more sense for you at retirement. So we're reaching the end of our presentation here, and looks like we're doing good on time. Perfect. We have more than enough time for Q&A as well. But before we go to Q&A, key takeaways. We talked about the destination, the retirement destination. It's unique to you. Your destination is truly your destination, and how you look at retirement, your expenses, income, has to be crafted and designed for you. Just be aware of some of these risks that we talked about: longevity, living too long, inflation, healthcare, long-term care costs. These are absolutely important to address with a financial professional as you're crafting your retirement strategy. Estimating expenses in retirement is critical as well. It's many times we sit down with clients and they do not want to talk about expenses. They do not want to create a budget. Especially in the first 3 to 5 years, it is extremely, extremely important to have a budget, to live by it, because if you remember when I talked about the sequence of returns risk, that's the critical time for the first 3 to 5 years. And sometimes I have seen individuals where they end up spending too much in the first 3 to 5 years of their retirement, and then they wonder what happened and why can't they, having certain risk for running out of money or running out of their assets at some point. So estimating and budgeting your expenses is important, but it's even critical in the first 3 to 5 years. And then taking a look at the different withdrawal strategies as well is important. So these takeaways, education is good, education is powerful. However, what's more powerful is taking action. So on the last page of the workbook that's in front of you, there's a section about actions. What action are you going to take? So put that down, write it down, as well as go ahead and put it, like once you write it down, take that and capture it into whatever tool you use. If you're using Outlook, put a to-do in the Outlook. If you're using Apple on your phone, put a task in there to whatever those to-do lists, those action steps are. And it could be as simple as talk to a financial advisor, right? It could be as simple as that, or call Mahesh, but write it down and put it on the calendar. And if we can be a resource, please do feel free to give us a call, reach out to us. Our phone number, it's not on the screen here, but I'll go ahead and put it in the chat box as well. But most of you have received our emails. Our contact information is in the emails as well. But feel free to give us a call if we could be a resource and help you craft some of these strategies that we talked about. So I'll pause for a moment and see if anyone has any questions about what we discussed. But do take a few moments to write in what actions you're going to take after this meeting. Let me look at the question box. I don't see any questions yet. I don't see anything in the chat box yet. So I'll take a moment here to put our contact information in the chat box. But if you do have any questions, please do start put it in the questions box. I'm going to go ahead and put a link as well for our scheduling software. So if anyone would like to book an appointment, they can use this link. To book an appointment as well. So you can directly access my calendar, and more than happy to chat with anyone if they have any questions. So let's see, I have some comments here. Comments or questions, let's see. There was a question from Kimberly. If we're unable to attend the previous event, will there be another time to attend? The previous event, all the events have been recorded, and the 4-week series were recorded, and they're going through compliance approval as we speak, and they will be made available as soon as they've gone through compliance approval. So that should, unfortunately, it takes a few weeks for them to review all the videos and document everything on their end. So, but as soon as it is approved, Kimberly, we'll make sure that we will share that those links with everyone. So Debbie, thank you for your comment. I appreciate it, and I also I'm glad to hear that you enjoyed the information as well. I do not see any other questions. So with that, I'm going to go ahead and end the call. Again, thank you everyone for being on the call today. I hope you got a lot of value out of this information. If we can be a resource, please reach out to us. This concludes our 4-week financial wellness seminar series that we put together. Now, next week, next Thursday, same time, same day, we have scheduled another webinar for crucial tax planning strategies for 2020. And we have a guest speaker from our investment management company, Dean Meoli. He will be speaking on tax strategies for 2020 and beyond. So if you are concerned about taxes, how much you pay on taxes, I would highly recommend that. Dean is very knowledgeable. He's a CPA as well. And if you're a CPA or no CPAs, we're also offering continuing education credits for CPAs for this event too. So if you have not received that invitation, please shoot me a quick email. The invitations went out last week, and the reminder went out this week as well. If you have not received the invitation, please send me a quick email. I'll make sure that you get the invite as well. But with that, thank you all for being over here. Have a great Thursday, and have a great weekend that's coming up. Take care.